Welcome back to Chinanomics. I have been speaking with Dr. Eshwar Prasad of Cornell University and Sanjeev Prasad of Deutch Bank, two people who know China inside out. Well, Dr. Prasad, the Chinese government did a great job of managing economic growth, sustaining over 10% for nearly 2 decades. Are they faltering on financial sector reforms? Are they sequencing the reforms wrongly?
China faces a very difficult situation in the sense that it's been trying to shift away from its dependence on investment-heavy growth. And an economy is investing nearly half of its output every year. That is not necessarily a bad thing, because China still does have very large infrastructure investment needs in its interior provinces, and this is an economy that still has a physical capital stock relative to output that is about 1/6 that of the US. The problem is that a lot of this investment is being financed through a banking system that is not doing a good job of intermediating domestic savings and foreign capital coming in into the most productive investments domestically, and that's the key issue, the efficiency of investment. So I think China can get a lot more in terms of productive capacity, in terms of output, if the financial system were to work better in terms of channeling investment into the right places. They could then bring down the level of investment, start having consumption play a much more important role in economic growth. And there has been progress in the last couple of years. The share of consumption relative to GDP, which is about 1/3 in China, far lower than any advanced economy or any other emerging market economy, is at least not falling anymore. It has been falling over the last decade, but in the last 2 or 3 years it started going up. The share of consumption growth, both private and household consumption, private and government consumption in overall economic growth, is now over 50%. The share of the service sector in the economy is a little over 50%. So they are beginning to move things in the right direction. The big question is whether it's fast enough, and whether while they undertake these reforms, they can prevent these bubbles from popping up. And as you've correctly pointed out, we did have problems in the housing market that seem to be subsiding right now. Now we have problems arising in the stock market. I suspect they'll be able to control this eventually. Next, I anticipate that shadow banking could be a problem as well. But the Chinese government has created enough resources and enough room for itself to be able to deal with these short-term hiccups. But there is a real risk that they don't use this opportunity in the next couple of years to undertake all the reforms that they plan to undertake. Then you could end up in a situation where the economy has too much investment, too much excess capacity in some industries where they already have excess capacity, and then things are going to turn really ugly.
Sanjeev, your take on the same thing. Would you say that Chinese authorities have got their sequencing badly? Should they have had more robust financial institutions, more capital account liberalization?
Well, it's difficult under these circumstances because the changes are so fast. So it's not like the authorities are not aware of what I am describing. But of course, these dynamics are continuously changing, and so it's not easy to blame authorities for the way, because you have to take into account the situation abroad and so on. So it's not like one can't blame anyone, but and it is the case that the authorities understand that they need to begin to open out, because in fact they have been doing quite a lot of it. They are creating all kinds of institutional mechanisms, not just for private money to go abroad, but also through official channels. So this is the context in which you need to think about the BRICS Bank, the AIIB. They're also creating FDI opportunities, whether creating the new Silk Route. It's not easy to manage this process exactly. So you will get these dislocations from time to time.
Dr. Prasad, we understand that the retail investor in China is largely poorly educated, not even graduates. Will this mean that there are going to be persistent problems for the Chinese securities markets?
Now, certainly, like in any other stock market, there are lots of speculative traders in China, but the real concern right now is whether the number of new entrants into the stock market, especially over the last few months, are going to make it harder for the authorities to let the market correct itself. These new investors who've got in have put down a significant amount of their savings in the stock market, and certainly there is going to be a fair bit of grumbling, a fair bit of pain. So the big question is whether the authorities are going to respond to that by saying that we are going to protect you small stock investors, and there is a danger to that, of course, because that creates moral hazard in the future. The government will be expected to step in every time there is volatility. So the government is managing this very high-wire balancing act. They do want to let the market forces play out, even if that means more stock market volatility, but at the same time they don't want it to erupt into social instability, which could in turn affect their ability to undertake economic reforms. And so far, the Chinese government has been slightly ham-handed in terms of first allowing the stock market to boom as it did, and now taking these very stringent measures to try to prop it up, and frankly being very interventionist. But I think they will begin to back off once the stock market stabilizes, or at least the rate of decline is no longer as fast. And then we could see a slightly greater decline in stock prices, which I don't think is going to hurt the Chinese economy very much in the long run.
What about the economy, Dr. Prasad? What is your trajectory of the Chinese economic growth? How much does it slow, say, next year and the year after?
Over the next 2 years, I think the Chinese government can easily achieve growth around its target rate of 7%. The big question in China is always not whether they will get the growth, but how they get it. If the economy starts slowing down, if the stock market turmoil has an effect on consumer confidence in particular, and hurts consumption growth, then the government may go back to its old playbook, the one they used during the global financial crisis in 2008-2009, where they expanded bank credit very significantly and had a big investment boom that kept the economy going. They can do that right now, but the risks are going to be very great because, first of all, monetary policy is not likely to have as much traction in terms of boosting growth, and second, it's going to create even more risks for the short term. So my sense is that the next couple of years are crucial, not because they're likely to miss their growth targets, but if they achieve their growth targets by going back to a credit-financed investment boom, and if that causes them to roll back the key reforms that they've started putting into place, especially the financial market reforms, then there are going to be very adverse implications both for the Chinese economy and in some sense through spillover effects on the world economy over the medium term. Because if China continues to invest very heavily in industries where it already has a lot of excess capacity and they can't absorb it domestically, they're going to have to export it. And that's not going to be good for the world economy.
Sanjeev, what is your estimate of the Chinese growth in the next 2 years?
I think if you're taking a 5 to 10 year horizon, you'll see a lot slower growth. The exact trajectory will depend on how this is managed. But yes, if you're looking at a 5 to 10 year horizon, why not 4 or 3 or whatever? I mean, remember, this is a country with a shrinking population. So even with low growth rates, the per capita income growth rate will still be pretty high. And China is not a very poor country. It's a middle income country with, if you have, you know, a GDP growth of 3 and you have a shrinking population, you can have 4.5%, 5% per capita income growth in the 5 to 10 year horizon, which will not be bad. So the point I'm making is, like, it's difficult to put exact numbers to these things, but I'm just trying to get people to understand the scale of magnitude. This is not about going from, about small changes. This is a structural shift in the growth trajectory.
Sanjeev, you mean the GDP growth can go even to 5 point something next year?
Well, I think I would be surprised if it's allowed to go below 6. But I think every year you can see a 0.5 percentage point or even a little more falling off is not surprising. And this is a structural thing. So even if the world global cycle picks up, this number could continue to fall.
Okay, Dr. Prasad, let us understand China from an India viewpoint. India may not have managed its growth, but it has an interest rate market, an interest rate set by banks and borrowers. India has a better FX market. Do you think India has got the financial sector reforms a little better than China has?
Now, India certainly has a lot of challenges on the financial sector front, but relatively speaking, certainly India is doing somewhat better than China. We are somewhat further ahead in terms of banking system reforms. We're further ahead in terms of the technical infrastructure and the corporate governance issues related to firms that list in the stock market. But this is not to say that India doesn't have enormous problems. The fact that non-performing loans are a big drag on the Indian banking system, which is not able to support Indian industry very well, is certainly a big concern. So I don't want to imply that India has got it quite right, but certainly India has done somewhat better than China in terms of the broader financial market reforms, especially in developing the equity markets. Both countries suffer from a lack of development of the corporate bond markets, which I think is an important channel for intermediating domestic savings into longer-term investment. And in India in particular, given the need for infrastructure investment, we certainly need to make progress there. But on the stock market, I think India has been able to use foreign investors and the liquidity they provide to generate more depth to those markets. Certainly it leads to more volatility at some times, but I think overall it's been relatively good for the performance of the stock market and for the stability of the stock market relative to what we see in China. In terms of banking reforms, the fact that the interest rate structure is liberalized is certainly something that China has been looking to. But I think China has also been studying how India has been approaching the difficult issue of how to get the public sector banks to work well. In China, the banking system is largely state-owned still, so they've been trying to move to a model of corporatization of the banks, where they start hardening the budget constraints on the banks, try to get them to respond to market forces, and also introduce an element of market discipline. And here again, India is a little further ahead, but still India has a long way to go. So I think financial market reforms are one area where there is a set of common challenges that these two economies face. Because unless they both get finance right, it's going to be very difficult to generate good, sustainable growth over the longer term, and especially growth where the benefits are spread more evenly across the population.
Okay, last question to you, Sanjeev. Your pet theory has been that China, from being a factory of the world, will become an investor of the world. Can you elucidate this?
Absolutely. So just like, if you go back to the 90s, when Japan was going through this, then you saw this explosion of Japanese investment abroad. We should expect that to happen. I mean, already Chinese investors are a big player in the global economy, but I think people are underestimating the sheer scale of what this could be. I mean, I have written about this, saying that we are probably entering an age of Chinese capital. And you will see Chinese investments in all kinds of, whether it's in the markets or FDI or official flows through AIIB and BRICS Bank. I think that will be the key determinant of the next round of global expansion. And the way the world absorbs this capital will determine how growth takes place in the next round. I think the amount of capital that will come out will be so large that ultimately the world will have to go back to global imbalances, with the US perhaps taking on the role again of absorbing a lot of this capital. And one hopes that in this next round, if it absorbs this capital, it will deploy it more efficiently. Instead of putting it into McMansions and consuming it, they will upgrade their infrastructure, which is in appalling state. So I hope that that happens, but if the US, for whatever reason, does not absorb a lot of this capital, you will have this problem of excess capital sloshing around in China will now become a global problem of excess capital sloshing around in the world, and you will have bubbles in the world as well.
All right, Dr. Prasad, Sanjeev, thank you very much for joining me in this very enlightening conversation. Well, the key takeaways: one, China's is a problem of excessive savings and a problem of how to channelize it quickly, because the savings are coming with such a rush. Two, Chinese economy will slow, but not a whole lot. Even next year, both Prasad and Sanyal expect that China should manage well over 6% growth, but in the distant future, in 5 years or so, it might slow to about 4% and less, according to Sanyal. China may stumble on financial sector reforms, sir. That's the third takeaway, but it will not be a hard landing. Prasad is quite confident that China will be able to manage its banking sector, shadow banking, real economy, real estate problems very well, although there might be slips of a minor kind. And finally, Sanyal's pet takeaway is that China will soon evolve from being a factory of the world to an investor of the world. It will be one of the biggest investors in countries outside China, probably even in India. That's it on this edition of Chinanomics. Thanks for watching.